Hello, I'm George Cattat, financial strategist with Four Oaks Financial. Welcome to Market Moments with George. Please like and subscribe to get weekly notifications.
Hey there, investors. Welcome back to another insightful episode where we break down the latest market news and trends that could impact your investment decisions. Today, we're diving into some crucial market updates you need to know about, from hedge funds shifting strategies to the Federal Reserve's potential rate cuts and the current state of mortgage rates. We've got a lot to cover. First up, hedge funds are growing increasingly bearish amid economic slowdown jitters, according to Goldman Sachs. These influential market players are starting to show signs of concern as economic indicators point towards a potential downturn. These big players are adjusting their strategies in anticipation of a potential downturn. They're reallocating their portfolios, moving away from high-risk assets and focusing more on safer investments. This shift in strategy is a clear indication that they are preparing for a less favorable economic environment. The uncertainty is driving them to pull back from risky assets, which could signal a cautious approach for the rest of us. When hedge funds start to play it safe, it's often a sign that individual investors should also consider re-evaluating their risk exposure. Next, let's talk about the Federal Reserve. The central bank's actions are always a focal point for investors, and right now, all eyes are on the potential for rate cuts. Fed rate cuts are looming large as the U.S. job market slows sharply. The latest employment reports have shown a significant slowdown in job growth, raising concerns about the overall health of the economy. With job growth stalling, the Fed might step in to lower interest rates in an attempt to stimulate the economy. Lower rates can make borrowing cheaper, potentially boosting spending and investment. This could provide some short-term relief, but it's also a sign that things might not be as rosy as they seem. While lower rates can help in the short term, they also indicate that the Fed is worried about the economy's trajectory. And finally, let's touch on mortgage rates. For many of you, this is a critical area of interest, especially if you're in the market for a new home or looking to refinance. Despite potential Fed rate cuts, mortgage rates are unlikely to fall enough for buyers to notice. The housing market remains tight, with high demand and limited supply keeping prices elevated. The housing market remains tight, and even slight decreases in rates may not make a significant impact. This means that while borrowing might become slightly cheaper, the overall cost of purchasing a home is still high. So, if you're hoping for a drop in your mortgage payments, it might not be in the cards just yet. It's essential to keep an eye on the broader economic factors that influence mortgage rates and housing affordability. To sum it all up, hedge funds are turning bearish. The Fed is contemplating rate cuts due to a slowing job market, and mortgage rates probably won't drop enough to make a difference for buyers. These indicators suggest a cautious outlook for the near future. It's a time for investors to stay vigilant and perhaps adopt a more conservative approach to their portfolios. As always, stay informed and consider your investment strategies carefully. Keeping up with the latest market trends and economic indicators can help you make more informed decisions and navigate these uncertain times. Thanks for watching, and I'll catch you in the next update. Stay savvy, investors. Remember, knowledge is power, and staying informed is your best strategy in these volatile times.
Take control of your financial future. Contact me today.